Good thing I didn't do this on CNBC. Can we take that off? Can we take that one off? Boom. There we go.
Cool.
All right. So yeah, stay there. All right, guys, we're going to get rolling. Obviously, a lot of time to make up, but I think we have a good presentation for it. We're going to take the screen off and just get you the information that you need. So, July 17th, I'm going to skip this. If you guys have been through this with us a few times, you know the deal here. In the interest of time with those technical difficulties, but we will get rolling. We'll also probably shorten this. We were looking forward to delivering this fun one. As he said, Kyle's been in Saratoga. He'll be here a total of 13 or 14 days. They have some big plans tonight, and I thought this was kind of funny. But why don't you explain what's happening here out in the town in Saratoga?
Yeah, so the in-laws are going to a nice polo match today, and we are going, me and my wife are going to, and 10-week-old are going to go see Weird Al, Yankovic's parody song tour. And I mean, personally, all sound, either would be fun, but we weren't going to miss Weird Al. That wasn't going to happen. So, so we'll be there. We'll report back. We'll let you know how weird it actually was. And
I didn't know he was still touring, but
yeah,
all right.
he's an icon. Been around forever.
Well, I don't know about that. But okay, so this was kind of funny. So Kyle's parents, in-laws sent us this, and what are we seeing here? This is beautiful baby Alice.
This is baby Alice. She is our youngest subscriber and future employee.
Future
analyst.
Or maybe LPGA player.
Exactly. Yes, one of the two.
All right, we'll get rolling. As I said, we'll try to get you caught up here. So earnings season for Q2 is underway. We've had some of the banks report, and on the whole, they're beating expectations, and guidance has been solid. So we're now in Thursday. We've seen BlackRock, we've seen Citi, JP, Wells Fargo. We did get Goldman. Goldman had a big beat. The stock has been doing extremely well. ASML, Dutch-based Semiconductor, also reported, and they usually kick off the growth trade, new age technology. Here we are Thursday. This morning, the market got a boost from Taiwan Semiconductor, which we will cover and look at some of those numbers. GE, which is also, on the break, not the breakup, but the spinoff of the three different companies has been quite interesting. We have Netflix tonight that we'll also cover. So that is going to be one that, we hold in the portfolios and we're going to be actively watching. American Express, Charles Schwab, which is the custodian of our wealth management business, coming up tomorrow before the open, and just a few up close if you want to refer to any of the expectations for revenue and EPS for today's earnings. And then the big one tonight, as I said, we're looking at Netflix. What are those numbers? Expected $11.08 billion on $7.06 of GAAP earnings. Netflix has been absolutely just a freight train on the upside. Interactive Brokers as well, also coming out. One thing that I've been watching with this market is the fact that even I would say the news that airs on the side of negative, or anything that should pull the market back in this a little bit less, I would say, more lightly participated market. I wouldn't say it's a typical summer doldrums market, but I would say any bad news has been greeted with buyers. And I think the biggest explanation with that, we're on camera right now. We got to be like moving back and forth, right? Baby. Any kind of bad news has just been met with buyers. And I think there's so many both institutional and retail investors who have been caught up in the whirlwind of headlines, both domestically in the political side and international and geopolitical side, that have caused them to be underinvested. So any scoop has been just bought up, and it can kind of put some data behind that. So, it's not just, as we're seeing here, it's not just hedge funds, foreign investors that, it's not just foreign and, diversification out of the U.S. with the drop in the dollar, it's hedge funds. And here is a graph of asset managers, hedge funds, net positioning overlaid on the S&P in black. This was put out by two of my friends, J.C. Peretz and then Ryan Dietrich, who was head of LPL, and now he went to Carson Group, the head technical analyst. But, quite a discrepancy between not just retail money, but institutional money. And this was from Reuters just 3 days ago. Hedge fund dumps banks ahead of earnings, and they've been moving into consumer staples. So, even now with the market ripping to new highs, the underinvestment by institutional money that continues to be on the sideline is just real. So, like I said, any kind of bad news, especially on the geopolitical front, is just immediately scooped up because so many are underparticipated. This was a slide from last week. We mentioned that the U.S. AAII, which is really hard to say, bull-bear spread was minus 5%, so that means that there is 5.2% more net bearish sentiment. Let me say this. There's 5.2% more respondents to their survey than there are bullish. So on the whole, the market was bearish, net bearish last week, with the market breaking to new highs. This is an updated chart that we just got off the press today. We went from minus 5 to positive 5.7. So yeah, the market's becoming more net positive in terms of sentiment. This is, more subjective. This is how people feel. This is, it's like the inflation expectations and consensus, which this is more of a qualitative study than a quantitative study. But, people are now net positive, but I think you can see here a very, very long way from being net and overly ambitious, I would say. So when you look at, here's the S&P, we'll look at some charts quickly. Here's the S&P on the weekly. Each one of these bars represents 1 week. That was the pretty incredible April of 25 sell-off, and then the corresponding V-shaped recovery. We break to new highs. Here is the daily chart. Again, one of the more amazing V-shaped bottoms that we've seen. And if you think back to that slide 2-3 ago about the underpositioning of institutional money, specifically hedge funds, with the market just, all it can do here in July is just go into this little technical holding pattern, which I think is very bullish. And, should we get the break above that consolidation, we're going to go. And then here's the NASDAQ. This is the NASDAQ 100. I tried to take a snapshot of the same period. The more tech-heavy NASDAQ is in consolidation, but I would almost argue, Kyle, that it's a little bit of an upward shape.
Yep.
So the money is continuing to go into tech, and I don't see anything bearish. I've been kind of steamrolling it. Is there anything you want to jump in on, or should we keep moving?
No, I agree. We're not seeing the bearishness. There's still a lot of tariff uncertainty and general uncertainty out there, which is why that positive sentiment isn't kind of where you would expect it to be when we're at all-time highs. So, as the uncertainty, plays itself out, whether tariffs and the geopolitical stuff, whether that escalates or if it settles down, then you could see this top get blown off more or less.
Nice.
Yeah.
Well said. All right. Back to that. Okay, perfect. And obviously, we're trying to make up time for you here, guys, and I apologize about those technical difficulties. I'm still getting used to life on a Mac. It's been a big transition.
Yeah.
It'll continue to go, but I'm happy with it. All right, so we mentioned Taiwan Semiconductor reported earnings this morning, and it was pretty spectacular. Couple quotes. This is directly from CNBC on both sides. CEO said on the earnings call, the company expects full year 2025 revenue to rise about 30% in dollar terms, supported by growth in AI and demand for its most advanced technologies. Primary driver of growth for Taiwan has been robust demand for AI-related chips, particularly the leading edge nodes below those 7 nanometer. So, it's in the new age, smaller chips that, this is going to be on the cutting edge of where we're going. And that's where, Intel has been left behind and those sub 7 nanometer chips. Here's the chart of Taiwan, and you can see, if you can screenshot in your mind the S&P and the NASDAQ, yeah, we broke above the pre-April highs, but, especially with the elevated geopolitical tensions and China waiting in the wings, we shall see. We haven't heard much on the China-Taiwan front, but, with the way the market is voting, the stock is just broken out. And if we look at, some of the data here, it's a $1.3 trillion market cap company, which we're going to look at NVIDIA, which just breached the $4 trillion market cap company. The PE ratio is only 27, and if you kind of consider what the current PE is on the trailing 12 months versus expectations going forward, the next 12 months, it's not overly expensive. If you look at green dots, that's where EPS has been reported in prior quarters compared to what consensus on the street is. And you can see the company is pretty consistently beating EPS. So we came in at 30.07 billion. Obviously, that's converted from Taiwanese dollars into US dollars. Expectations of 30.04. EPS beat significantly, 2.47 versus 2.37, and I do believe that's GAAP earnings. So good top and bottom line beat, and we had ASML come out. We just had Taiwan, and the chip trade, particularly in the growth trade, is powering that ahead, and that's why the NASDAQ has that more bullish tilt than the S&P. This is mind-blowing. I was just reading about this morning. This, I hope I pronounce it right. The Kobesi. How would you do that, Kyle?
I have no idea.
Yeah.
Kobesi,
very widely followed research publication company, came up with a pretty interesting stat with NVIDIA compared to the overall components of the MSCI All Country World Index. I know in here it covers about 85% of global equity markets. So the weightings of all these different components make up 85% of the market capitalization of global equities. And the point that he's making here, and this tweet went viral, I should have included the tweets and retweets and shares and all that kind of stuff. NVIDIA's weight alone is now larger than Japan's 4.65% share, the world's third largest stock market. NVIDIA is larger, the market cap is larger than the world's third largest economy. What?
Yep.
That's insane.
Soon it'll be bigger market cap than France and Germany combined.
I think it is already right now.
Yeah, that's crazy.
So it's bigger than France and Germany combined. It eclipsed Japan in terms of their total market capitalization. Is now, you're right. Is now nearly as large as France and Germany. Sorry.
Maybe by next week.
We'll see. And again, guys, I'm at heart, I'm a chartist. I always love to see what the market has done, significant decision points. The charts are very, very important because, this is a very visible, obvious ceiling right about Kyle, you're closer to it. What's that number?
153,
50,
just under.
53. It didn't even have a problem breaking through that 53, 55. It, hot knife through butter, came back on the retest,
tested it,
and then just boom. So you're at probably almost a $4.1 trillion market cap company. And again, the company's only trading about 35 times next year's earnings. And again, if you just go back to what the point I was trying to make in terms of the underpositioning of hedge funds and other institutional money and retail with only that net 5.2% AAII bull bear spread, people are still not trusting this market. And I think they're going to have to, let's be dramatic on this, Kyle. I think the catch-up trade, any negative news, as I mentioned, is just bought up from people who have missed the train. I mean, July, we're going to get into some seasonality. This is historically the most bullish month, I think, over the last 20 years. And maybe we're going to go quiet in August. We're going to get potentially our first Fed rate cut in July and September. Maybe the market is going to ramp through the summer. I don't know. This is not a prediction. I don't know. What do you think, man?
I mean, it's a crazy company. There's other huge companies that are built on their architecture, and then you factor in physical AI, like automated manufacturing getting a lot better, all this robotaxi and all these driverless cars, and all just gets powered by NVIDIA, and it just seems like the future of this economic transformation. And then you look at their GPUs, they have 70% of the GPU market. Like it's a crazy company. It is. I don't even know what other company to compare it to.
It's potentially one of the most historic companies, maybe Henry Ford pushing us from carriages into a problem we didn't know we needed, which was to move to
seriously
powered automobiles. But and every week, like I follow AI newsletters, and just the implications and the use cases for AI just continues to bewilder. Like I was listening to a podcast on education and teachers. I mean, could teachers potentially be replaced, or significantly, could their job be greatly enhanced in terms of teaching and grading papers and giving feedback to students and working one-on-one with students? Like teaching, I mean, the healthcare we know. Oh my gosh, like it's crazy. I really do believe that we're in the early innings of this AI technological boom that's could touch all industries. And the fact that NVIDIA, one of our companies in the U.S., is larger than the Japanese stock market. I mean, I don't want to be rah perma bull. I'm not. We're opportunistic traders, and when signs are there that perhaps we're overbought with sentiment readings, and the exuberance is just too much, like we can look the other way, and we're going to do that. But right now, I'm still seeing the boat loaded a little too much on the bearish side and not on the bullish side, and embracing, I think, what's ahead of us.
Yeah.
But I'm not pounding the table either way. I'm just telling you what I see, and that's one of the beauties. I think one of the strong suits of why clients come to us is we are not set it and forget it and always be in. I mean, we're really going to actively look to participate and protect on the downside. In our more active accounts, we'll participate on the downside. In our longer term models, we're going to protect when things look rocky. So important to keep that in mind. All right, back on track. So that's NVIDIA. As I mentioned, July just continues to be the strongest month. That is from 2006 to 25. I carried this slide over from last week just to underline that point over the last 19 years. July continues to be strong, and August isn't terrible. I would say mid-range. September is one of the weakest months. It's February and September. So we have seasonality behind us, combined, as I said, with earnings season for Q2. Netflix is tonight. Netflix is a good size holding in our Tactical Alpha Growth holding. We have a 3% allocation. NVIDIA. I got NVIDIA on the mind. Netflix represents a 1% holding in the S&P. We're at 3%. We have a chart, that has been pretty spectacular. Kyle was laughing, saying it's recession proof. Even if we do go into recession, people can sit home and watch Netflix.
Yep. New subscribers,
yeah. The stock has pulled back from 1375, 1380. I do know, I didn't include it here. I did look at analyst expectations. The consensus is around 1250, 1275 for year-end targets, though. Analysts are seldom ahead of the curve. They're usually in catch-up mode. But, the stock has pulled back a bit, and I would say it's completely healthy after going from 825 to 1300. You're going to have 6 steps forward and maybe 1 step back. Yeah. And I would just note it's on decreasing volume. So I don't really see any, urgent selling. I think it's just natural. It's just natural give and take and ebb and flow of the market. So we have earnings coming up tonight. Our revs expected of 11.05 billion, GAAP EPS of 706, which is crazy. $7.06 per share. I mean, they could issue more shares. You look at the history of where this company has been. So bullish in Netflix, nothing really to do. I'm content with a 3% allocation within communications in Netflix. I tried my best to shade out the other 3 holdings, but I think you could probably detect what's there in tag within comms. And again, this is our growth portfolio at Inside Edge. The big one tonight is going to be operating margins. The margins here are in blue. This is EBIT margins, also known as operating margins. So earnings before income and tax, EBITDA, obviously is going to be depreciation and amortization. But you look at the EBIT margin that the company has been experiencing, and that's in the blue here, overlaid on EPS. So non-GAAP EPS growth going back to 18. Obviously, EPS has been growing quite significantly, as has margins. And that's the key. That's the big driver with this company is, I did CNBC for a while covering Netflix, and we would always talk about when are they going to finally crack down on password sharing. Like, I log into my Netflix account and like half of my extended family is logged into my Netflix account.
Our Airbnb, we're using Steve's Netflix right now. Thank you, Steve,
Thanks,
for
Steve.
the access. Yeah, I appreciate it.
And it's like we would joke on air. We'd be like, shh, don't tell them. And they know. And what they were doing is they were studying people's watch patterns and stuff they were doing. They were gathering a ton of data. And they were just waiting for a time when they needed to crack down on that password sharing. And that's what they're beginning to do. So, I think the big part here is I have, okay. Projections are driven by the low-cost ad-supported tier as well. So they are bringing advertising revenue as well as a crackdown of password sharing, which have spurred subscriber growth and revenue. And again, that's what's driving those margins. So ad-supported, I'm just kind of reading here. By early 2025, the tiers attracted 94 million MAUs, up from 40 million the previous year. They've more than doubled their MAUs with this low-cost ad-supported model. They are moving into live sports, WWE, NFL. You know how I feel on MLB as it's going onto the international stage, beyond just South America, but also I think it's gaining a lot of popularity in Asia with the Japanese and Korean players becoming so good. Subscriber growth, just cracked down on password sharing, 41 million net signups. So that's pretty impressive, and that's driving margins. So, if you just look at the revenue growth, I mean, look at this. This is from 2020. Oh, this is quarterly. You look at the quarterly percent growth in the same quarter of the prior years, 15, 16, 12.5, 15, 14, 13, 14. They're consistently growing 13%. Their revenue, that's their revenues, excuse me. And then their EPS, the EPS is in the red bar chart here. But if you look at the percent year-over-year change, it's crazy how fast they're growing. 25%, 45%, 24%, 24, 19, 17. I mean, that's why the stock has done so incredibly well. So let's watch those margin numbers. You always want to look at the MAUs, monthly active users, and also the international subscribers that are added. Those are going to be some stats we want to look at for tonight. All right, dude.
Yeah. Inflation report for June came out yesterday, picking up. So this is kind of what everyone had expected with tariffs and costs on products increasing because of those tariffs, and we saw kind of a muted year on inflation until now. It does look like it's starting to pick up a hair at 2.7. The Fed's target is around 2, so it's still a little above where they're saying. This is a good, I guess, a vindication for Powell, the Fed chairman, saying that there was inflation pressure based on tariffs and whatnot. So, kind of what you would mathematically expect for an economy that's really strong, showing good GDP growth, people earning, spending more, along with the tariff, which, mathematically you would expect a higher cost on imports causing prices on some goods to go up. So probably an indication, just relating it back to the Fed and interest rates, probably an indication that we won't see a rate decreases any sooner than is currently expected.
Nice. And a lot of what's interesting is though, even though, and I think this is part of what they're trying to. Sorry, get this mic out of the way. Even though the U.S. tariff policy is potentially driving domestic inflation, what we're doing is we're importing deflation. Mm-hmm. China is certainly suffering from deflation, not even disinflationary, but deflationary pressures. Europe is not in an inflationary situation at all. There's a lot of deflationary pressures around the globe. And I think the economic team behind Trump knows that. And at the headline domestically, yeah, it's inflationary. But there's counterbalances with weakness in other countries, one. And two, technology, AI, what we're talking about, is inherently deflationary because it increases the efficiency, the operating efficiency of companies, and it decreases the overhead costs. We have the cost up front that goes to NVIDIA to buy thousands of GPUs, but once they're there, that's what gives companies operating leverage, and that's why the market is trading at a higher valuation, I think, than normal. I don't know if you have.
Yep. No, makes sense.
Yeah. All right, good stuff there. Back to CPI. Yeah, the next few CPI reports, if it doesn't show inflation with Trump tariffs in, the market is, maybe the market's discounting it in right now. Maybe that's what we're seeing. Maybe the market is betting that we're not going to see significant uptick in inflation, and the market's discounting that 6 to 9 to 12 months in advance. I don't know. But if we rip following benign 2.5, 2.7 CPIs, then we'll know that the market didn't discount it in, and they're still playing catch up. Bitcoin. This is an interesting one. We hold IBIT in both our Active Opps portfolio as well as TAG, Tactical Alpha Growth. Bitcoin is now ripping at all-time highs, coming up 120,000. You can see the breakout again. I love drawing my simple lines, getting my crayons out and drawing on pictures. But that was the ceiling. That was the line in the sand. We tried it since November of 24, and finally in the last week and a half, not only we break, but we gap through. And we've been consolidating much like the broader market, and I believe we're going to continue to go higher. From the technical work that I do behind the scenes in this deep, dark bunker, I do know there's a 170 to 175,000 cluster of resistance. So maybe just mark that down, and if we get a move up in there, we see hesitation about 175,000, watch out. So it continues to break out with increased institutional adoption, relatively more clear outlook on U.S. regulatory stance with the Genius Act. And what I'm seeing, again, maybe it's summer doldrums, thinner market, and correlations tend to wander in thinner environments. But we're seeing it act as a risk-on digital AI build-out proxy, the new digital age, which that's what we're being pitched as to why Bitcoin is the future. But it's also acting as a safe haven. When we do have sell-offs in the market, as I was trying to mention, they're very brief. You see money flowing into Bitcoin. So it's also acting as a safe haven in here. So I don't know, and I don't think anybody knows.
Yeah.
But I don't know. Do you have any thoughts on that?
Yeah, people see it differently.
Yeah.
So some people see it as a hedge against, treasuries and all that. Some people see it integral for the digital age, and that gives people different reasons to invest. So what can you say? It took me 10 years to understand Bitcoin. So yeah, I think investors are still figuring it out.
I was sitting here last night. My dad was over, and I had him buy Bitcoin in 2017. Not a lot, but he showed me his Coinbase account. He's like, Todd, why didn't I just put my whole retirement?
Yeah.
I'm like, no, Dad.
Good old hindsight.
And I'm the dumbass. I bought 10 Bitcoin. I've got it on my Coinbase at like 330 up to $500, and I sold them at like $2,000. I was like, that's a great trade.
Yep.
Awesome.
Good old hindsight.
Well, I mean, whatever. I don't know. What is that? 6x, 7x, 8x? I don't know.
Good enough to sell. Yeah.
It's crazy. Who knows?
People used to buy pizza with Bitcoins for $4 in like 2010. It used to be. No one knew then.
I mean, is it going to go to 1 million? I don't know. I don't know. It's so crazy. It's a new world we live in. Okay. So Bitcoin, and then you have... Okay, tell me what's going on with this now.
So this has been in the news quite a bit lately. BMNR, if you've heard of MicroStrategy, it's basically a Bitcoin treasury. MicroStrategy is, and it's been in the news a lot the last year. Definitely surged along with the price of Bitcoin itself. This is basically the equivalent of MicroStrategy, but for another crypto called Ethereum. Ethereum, basically, the way I would describe it is it has a little more utility. It's used to be traded for digital assets, kind of as a currency exchange. So that's kind of its way it sees itself as different. They appointed Tom Lee as chairman earlier this year. It caused a massive spike that you can see on the chart here from around $5 up to over $125 at one point, and then it settled today around 44. So just interesting to see these stocks, the companies that basically had a different role. This company originally started as a blockchain mining firm, and then they decided to change their corporate strategy to become a treasury, buying, in this case, 500 million of Ethereum holdings, and then using different avenues to buy more and more Ethereum in the future. So it's interesting to see these companies taking off.
Nice. All right, good stuff. All right, so we're going to say goodbye in the public stream for now. And we're going to say thank you for joining us. And sorry again about the tech issues. I got to work through why it didn't work properly. I'll get on it. Thanks for hanging with us if you've done so far. To investors at Inside Edge, because that stream is not working properly, we're going to hold off on doing client-specific stuff. I think we should record. Yeah. And then send it out to them and put them in the member portal. Yeah. Kind of figure out what's going on with the tech, and we'll jump on it. But sounds good. We have investor specific stuff that we'd like to share, specifically how we model risk. Do you want to talk about it a little bit?
Yeah, sure. So for clients, you should be seeing an email today with your Riskalyze current portfolio report. That's going to show the risk and return kind of characterization of your model, of your portfolperfoliio. So do you want to show some of this, or is this client only? We can show the first view. That's fine.
Okay. All right.
I'll stop you.
Okay. Perfect.
So just to give a visual of what we're talking about and the kind of the software that we use with our clients. This software is called Riskalyze. It rebranded to Nitrogen a few years ago. And the basic premise is that people are twice as concerned about avoiding losses than they are about achieving gains. It just shows people are a little more risk averse in general than they are kind of opportunistic for getting more, seeing their accounts grow. And this, in practice, as an investor, we've all been here, so no one can say they haven't. Anyone who trades knows that people can tend to sabotage their own investing by selling when they get scared, when they see a drop in the markets, selling at the wrong time, sitting out for most of the recovery, and then waiting for the recovery to buy back. And so that's...
and I'm not shaking my head at Kyle. I'm just, and I don't want to stereotype people, but it's usually the smartest people.
It is. It's a bias, and mostly smart people are traders, and so it's like that overthinking, thinking that you can, I guess, see the reward without feeling the risk. But I mean, that's the risk and the volatility. Honestly, is what creates the reward, in my opinion. Because if you can wait through that, then you can see if you look historically, market has gone up over time. If you can wait out those periods of volatility, then you usually get rewarded as long as you're in good investments, solid stocks. So that's where a lot of people trip up, and we've seen it time and time again. It's just a existential reality of being an investor.
And I mean, and that's why I think we structured the firm as we did, whereby we have, financial planning, I think is really, really important for Kyle, for our clients to fully participate in the process, the discovery process of, what your appetite for risk is. And there is no right or wrong answer. It depends on your life situation, what this money, different accounts are earmarked for, how you feel about the market. Are you overly influenced by politics? And a lot of people come in because we cater to a lot of traders who think they're very risk seeking, but when it comes down to it, they're actually incredibly risk averse. Mm-hmm. And if you don't go through the planning process, the financial planning to, again, understand and organize your accounts and then align them with the goals that you have, and also go through the risk-alize processes. Kyle just mentioned you have a risk number. Only after you go through that process do you have confidence to see the investment plan through, get through the volatility, as Kyle just mentioned, and realize the rewards that I think are very much available in this market. So, the more active, your mind is. I mean, I've been trading my entire career, which is just 22 years. The more you got to get to know yourself and how you self-sabotage and your own, idiosyncrasies that prevent you from realizing your maximum return. You got to work around that, and you've got to account for that. And I think the process that Kyle's mentioning is going to help, especially those with an overactive mind, which we deal with. We tend to attract that.
Yeah,
is that fair? I don't know how to say this.
They're just hands-on traders.
Yeah,
quite a few of our clients, and it's a great thing. But we can come in and help people avoid some of those mistakes. Part of it is being there when you have a question, and the other part is doing the upfront work. This software is going to quantify, with hard numbers. If another 2008. Financial crisis happened. There's another slide in there that shows the stress test. But
should we go forward?
Yeah, sure.
Okay.
So this is the questionnaire. I mean, we want to see, based on your exact answers to this quiz that we go through, how much are you okay seeing in the red part of this page? This is the downside risk. And the questionnaire is going to dial into that amount of risk that you're comfortable. I mean, everyone wants to see their investment accounts go up, but what's the fine print? What's the cost of seeing those returns? It's experiencing volatility in your account, whether you check it every day or once a year. You're still going to have volatility in your account if you're a risky investor. Those who can sit through that should experience the reward on the upside. But the thing we want to avoid is getting you in a portfolio that's too risky for you to sit through that downside. We don't want you to be overly aggressive.
Well said. Continue on, or?
Yeah.
Yeah.
Go to 2 slides forward.
Okay.
So just to kind of emphasize, we have the report that shows your risk score. We also have this stress test, so it can show you the historical volatility based on our individual models, which you can see both of our models here on the graphic on the right. Tactical Alpha Growth, which is our growth model, going to have a higher risk score. And then Strategic Income and Growth, that's our value model. Everything in there pays the dividends. More value-leaning stocks, and then the S&P 500 as a benchmark in the middle. So we want you to understand, what can go wrong. The downside percentages, as you can see on the growth model, are going to be higher than the S&P or the value model that we have. And just to note, this is based on a passively or a non-actively managed model, so it's basically a snapshot in time. As active managers, we want you to be prepared to see this volatility, but what we're also doing when we clock in every day is we do make efforts to limit this volatility on the downside so that you're not, don't want to make this seem like we're passive and seeing these gains without getting defensive on our end. But we do want you to see, if you are in our growth model, you could see over a 30% decline in that account based on bear markets that we've seen in the past. Yep. So we want you to make sure that that's a possibility. Make sure that you're okay sitting with it. If not, let's look at our value model. Let's look at some fixed income. Like there's ways to find kind of where you want and then need to be, honestly.
And the fact that we have a risk score of our so-called value, again, every stock within SIG, strategic income and growth, pays a dividend. But the high dividend, we don't reach for more than a portfolio average about 2.5-3%, because we are, I believe, in a secular bull market where growth in the underlying company is going to be a big part of the return, and that's why even our value model has a higher risk score than the S&P. Can you talk to that a little bit more, or is that just pretty much the way it is?
Historically, so we had this software when we started. We moved away from it and then readopted it. But in my time here, SIG has always been like 76 to 78 risk score. It will get more conservative when we do raise cash and when we go defensive, which I kind of joined right at the end of the 22 bear market. Yeah. So I didn't see what the risk score was at that point. But we do, we want capital appreciation in your value portfolio. And then we use our active management to, so that explains the higher risk score. And then we're using our active management to limit on the downside, even if you do see that it is more risky, you could say, than the S&P 500 index, as it shows on those two middle, so the 2008 bear market. But what we can do on our side is show you, how we've navigated, based on our previous allocations, on our portfolio management, we can show you how we've taken defensive steps in practice. So this is just, like I said, just a snapshot in time, based on how the model is allocated today.
Got it.
Yeah.
All right. Let me take this. Good stuff. Let me go back over here to... Nope. Sorry. I'm getting a D- on technology today.
You might still be a Windows guy.
Yeah, I might be a Windows guy. I like Mac though.
It's cool.
And I think one of the main points that Kyle made is, the so-called value model with the higher risk score, that is indicative of our view that we are in a secular bull market and we're trying to put some alpha down to the benchmark, which is the S&P. That will not always be a reality. And trust me, I feel like I may be skating a little too close to the sun with that value fund having so much growth in it. And there will be a time where I really want to get that risk score down into the 60s because, we have retirees, we have people in there who, if they've been with us for any period of time, they have significant gains on that. Right. But it's not something that I want to continue on. But, we need to, what's the saying? We need to make hay?
Make hay while the sun shines.
The sun is shining, yeah. So just keep that in mind. And to invest,
I wouldn't take it too hard. If you look at an iShare, go look at IVE, I think it is, or the value, S&P 500 value, it has not done very well the past few years. So if you're just straight defensive and value stocks the past few years, Exxon, all the big ones that you could think of, then you have not done very well the past few years. So it's following a trend at this point. I remember when you added, when Nvidia started paying a dividend, we added it to the SIG model.
Yeah.
So I mean, that's what you're paying us for, I think. And the rule we set up where everything in there has to pay a dividend, that's not going to change. And then it's always going to be more conservative than our growth model, which is maximum capital appreciation over time that
Yep.
we're targeting, SIG is always going to be more defensive than that.
I mean, it has
relatively speaking.
Has Nvidia, which pays like a 0.25% dividend, has Broadcom in there that pays a dividend, and has Taiwan Semiconductor in there, but we're not always going to be there. So for now, we're going to remain to try to put those returns up and justify our 1% cost per year.
Absolutely, yeah.
Anything else here? Should we cut it?
Yeah, if people are interested, go a couple more. Yeah,
Okay.
go to that one.
Okay.
The last one.
Okay.
One more.
Okay. There you go. And
Just for context, we do obviously, we're going to limit the volatility as much as it needs to be. Those were some crazy numbers on the past few screens with the downside risk. We want to make a portfolio that works for you. We can blend our value model, our growth model with these two models, which one is our fixed income model. It's a long-term bond model with a little more capital appreciation potential than our capital preservation model, which is kind of the ultimate capital preservation. It's two ETFs that we like, which is made to, you can see the volatility fluctuation range there on both of them, with the cap model only showing a 0.19% potential decrease, based on historical price movements. So we're using a blend. We want to find something that works for you. If you take a questionnaire, we run a financial plan as well, and we kind of confirm where we want to be as far as your risk score goes, as far as your target return objective goes. Then that's something like we're bringing all that information together. It's not just risk-wise, to make a very educated decision, give you some confidence in the way your portfolio is being invested.
Yep, sounds good. I'd say good job, man.
Yeah,
well done.
Solid.
Sorry about the tech issues. I'm gonna work through it. I'm gonna get up and rolling on Mac, and we'll have it smooth. And then for investors,
Definitely.
we'll have the Vimeo within the members area, the insiders area of Inside Edge. That'll be ready to go. But all in all, it's solid. Love how the market's behaving. I think the Fed's mostly out of the picture till September. Whether they cut, we'll see. We'll see what's going on with tariffs. There's a lot overhanging us, but the market just continues to defy gravity. And these Q2 earnings are going to be really, really interesting. We have to wait. Nvidia, which is really annoying, is at the end of the reporting cycle by multiple weeks. You got to get through all of the earnings, and then Nvidia comes out like 2 weeks later. That'll be the big one. These earnings could be pretty spectacular. So I think the market is bidding up ahead of it. So if you find that you're underinvested, or perhaps your advisor, if you look at the performance they've put up, if you're underperforming their respective benchmarks, maybe it's time to take a good cold hard look. And it's not an overly complex process to transition to Inside Edge. So let us know. If not, you'll have to wait till next week on the next free public video update.
Yeah, more to come.
More to come. All right. Hey, thanks for hanging out with us. Enjoy the rest of this beautiful July week. Have fun at Weird Al tonight.
Oh, yeah.
Your in-laws are going to the polo match, which would be super awesome. That's great.
Yep.
Have you had fun up here in Saratoga?
Yeah, I like it.
Yeah.
It's a good spot.
We should have put a video up. One client of ours, he took his wakeboarding up on Lake George. That was great.
It was fun.
How was Lake George?
It was amazing. Everyone I've talked to about, what I should do up here has mentioned it, and for good reason.
Yeah.
Lake's awesome.
It's awesome. All right. All the best, guys. Thanks, and have a great rest of the day. We'll talk with you guys soon. Thanks so much.
See y'all.
Oh, yeah. Remember this? All right.
Still alive?
Yeah. Finished. There we go.